my name is Vineet Tyagi. I welcome you all back to Tech Tuesdays. During COVID, we took a long break, and it was a really long break. But I welcome you back with a promise that you get to hear from us on Tech Tuesdays and connect with us every fortnight going forward. And we have many interesting things lined up too. Well, the RBI new lending guidelines, and some of which have come out and some of which are still to come out and will come out over the remaining part of this year and next year hopefully, are an important step. They are helping fintechs focus, they are helping us remind ourselves as fintechs what we have been doing well and what we have been doing wrong. And I think the impact is quite pervasive, but it's for the good. The typical areas where I see the impact happening will be the areas of better customer engagement, more transparency, and building trust with the customers. The second area where I see that fintechs will see an impact will be on good corporate governance and also the ability to focus on the right compliance that is needed to operate in a business climate that builds a healthy trust between all the parties involved in this lending ecosystem, whether it is the lenders themselves, whether it is the fintechs who might be facilitating or lending, and the customers. So in this whole ecosystem, we really have to focus now on creating the trust, better corporate governance, compliance. And I think RBI biggest impact area is that, and that's we should look forward. There will be short-term hurdles. Obviously, this does impact a lot of areas where customer consent has to be recorded. There's a lot of transparency being asked by the RBI regulations for the fintechs to declare the fees, partnerships element and whatnot. There's also a direct impact on the FLDG models, which were pretty much becoming a norm of partnering between the banks and the fintechs. That will be causing some short-term impact and slowdowns to happen. But overall, I think the positive side of it, as I said earlier, will be seen in the fact that we will have much deeper and better customer engagement that fintechs will invest in. And that will also lead to newer use cases, in my opinion, and building of better products for the customer, understanding the customer needs much better, and then engaging them in a most trustworthy environment going forward. So that's the flip side of it. That's the positive side of it. We might see a temporary slowdown, but that slowdown gives us the think time as a fintech to really focus on some of these things and create solutions for better engagement with the customer. Well, fintechs are in some sense and fashion equipped, and in many sense and fashion they're not. There has to be a lot of rethinking on the business strategy angle. There's a lot of rethink on the corporate governance and business structures as well. So we will see some element of NBFC or fintech taking NBFC license or leveraging their NBFC licenses to be in a better shape. They will also have to focus much deeper into technology, into regulatory reporting, into managing and servicing of the loans, and also the loan origination systems have to be becoming more deeply entrenched as a voice of the customer. So there are a variety of these areas where fintechs will have to be prepared. I don't think so everybody's prepared right now, but I think over the next few months there will be initiatives that have to be undertaken to make that preparation and take these regulations as a stepping stone to make our engagement and solving the need of small businesses much better. It will, like I said earlier, the lending is going to slow down because there are new guidelines and we have to adhere to these guidelines. So lending will become a little constrained. I don't think it is a major negative slowdown. What we will see is a temporary slowdown for the coming months, but when we get out of this, when we get better prepared to handling this, fintechs will see a better acceleration and a better uptake into lending. And I think that will also be well supported by the regulator, it will be well understood by the regulator. So there may be a small, I would say a roadblock or a hiccup, but it's all for the better. I think once we are over this hump, and fintechs take the right step and use really technology in the right sense to build better models, better governance and better understanding of customer, it will, I think, in my opinion, can lead to an explosion of the real benefit of fintech and banks coming together. I think RBI made one thing clear. They do care about this. They also see the opportunity being driving factor. So RBI is getting involved in this because they know that if India has to increase its share of SME contributing to the GDP from 30% to 50 to even further therefore they need a lot of support to come from different areas, and fintechs are poised to bring that growth and accelerate that growth. So I think RBI regulations will increase in a positive way. It's not that this industry is likely to get over-regulated in that sense, but regulations for the good, so that the interest of the small businesses, the interest of the consumer, the interest of the bank, the interest of the lender, the interest of the debt market, capital market, all the players is protected. And what we are creating is not just chasing growth by being in a mad rush, but we are building a sustainable growth model that can power India ahead. So yes, I think the RBI guidelines are just a beginning. There will be further impact and further regulations that will evolve in this sector. This is just a beginning, most likely, but it's all for the good.